Hello, everyone, and welcome back to our second market iteration with Rich.
Hello?
And I'm Knight. Let's get right into it. So last week we had another volatile week with the market ending down 17.5%, which brings for since the high in February down 35% and year to date down 33%. Now we do want to say that that's a very large number, but your portfolios are not down that much.
And one of the things I want to focus upon is a parallel we're seeing in the markets, similar to what happened in March of 2009, which was the low point of the market correction. At that time, the markets corrected and dropped the most, just as Congress was looking at putting together a stimulus package, very similar to what we're witnessing in our current situation. And once the package got passed, which we know this one will too, the market then began to improve and had a steady growth going up. Didn't mean that some days weren't down and some days were up, but more up days occurred. And that went on for approximately 12 years.
So basically, what I'm hearing is that as we're waiting for this stimulus package in Congress to get passed, the market continues to go down, which is what we saw last week. But your expectation is as soon as the Democrats and Republicans can align on a stimulus package and an amount, we'll see a rebound in the market.
Yes, what we'll see is I'm hoping to see something on Monday. If not, we're going to probably see another down day. But the depth of the market going down is putting a lot of pressure on Congress to pass a stimulus package, and I am fairly confident we'll see something next week.
Well, I think for one of the important things that we want to highlight is what can we do in a down market, and are there any benefits of this current situation? And I think this would be the perfect time to talk about tax loss harvesting and exactly what it is. So the most important thing for all our clients is to stay in the market to some degree and enjoy the recovery. The worst thing that anyone can do in their portfolio is to sell out of the market and miss the entire recovery together. That would be the absolute worst thing. Is that what you would agree on?
I do, and the experience that we had in 2008 is that everybody who stayed in the market did very well, and everybody who got out was sorry that they had pulled out.
But what we can do when we're at one of the bottoms of the market is tax loss harvesting. And what that does is it locks in your losses. So we have had losses this year, obviously, and locking in those losses, but then instantly reinvesting in the market. So we capture that loss in taxable accounts. So this doesn't count for your retirement accounts, any kind of non-qualified account like that, but any taxable account, trust, individual accounts, joint accounts, we can sell the losses, capture them, and then instantly reinvest them back in the market so that way our clients can continue to enjoy the upswing.
And when markets have improved and they start taking gains, they won't be paying any taxes on those gains because they'll have these captured losses tax losses to offset it. So as an investment, you won't change your allocation, but as a tax situation goes forward, you'll be able to take advantage of this situation. It worked very well when we did it in 2008, and we think it's going to work very well for you now.
Yeah, so that's kind of where our thoughts and minds are for this past week and this next week upcoming. So I hope you guys have a great rest of your day. And if you have any questions, please feel free to reach out to either one of us. Thank you.
Right.